So on your papers, it's a group paper. I'll set it up as an assignment so y'all all get it, but I only need one of you to send it, but make sure all your team members on the assignment. I'll make the official due date Saturday at 2. If you're late, I don't count off for lateness, but if you're late, you're killing yourself because you're shortening the semester. And also it means I may not grade it very fast. So try to get it in on time. For the couple of teams that are struggling because your industries are tough, like Sasha doing IMAX and Matthew doing Swin or whatever, Sherwin. There's a few approaches. You can ignore it and just ignore IMAX in your paper and just write it. And then Sasha might have to add a few extra words to try to bring the link. You can add a few paragraphs on the buyer power and supplier power. Just say, we also have this other company, doesn't quite fit in. Or you can essentially write 2 or 3 papers. So your choice on how you want to do it. Because industries are always tough. You're going to see the same issue you're going to have a little bit on paper 4, not as bad, but it's tough to define an industry. When you say who's the competitor for Disney, there isn't a competitor to Disney. They do too many things. Same thing with Microsoft. So it's just tough. Even HEB, I know they're not public, but our McDonald's, yeah, it's a food, fast food, but it's also real estate companies. So you're not going to find perfect companies that's going to fit in everyone. So do your best, get paper 2. Also, what I'm going to send is the team assessment. That you will each do that. And that's where your grade can be adjusted up or down depending on how you do it. So I'll have categories like Superman, Superwoman, did well above, did what we needed, never saw them once the entire semester, those kind of categories. So you can let me know. If one person's real negative and everything's positive, then I'll say that's just one person who's upset, mad. If most of the team members are saying the same things. So the problem with doing that is you got 2 days, and now that one person who's worried, they're now going to try to do everything, and it's actually irritate the rest of the team. So be careful of that. So you got to figure out how to do this. I remember some of my classes with group. I remember I had a cybersecurity student in one class. And my word, he owned that team. He kept them out of trouble. He got everything going. He had problems with the group. He fixed them all. I was like, hey, if you need a reference for our job, you come to me, because that's the employee I would want to hire. So group projects, a lot of students is like, well, I'll be a good group project when I get a job. You better start now on practicing those habits, because boy, it's gonna come back to bite you later. So, but it's too late now because you only have 2 days left. But anyway. So I'll put that out there. So you'll have 2 things to fill out this weekend or send in this weekend. I'll get them graded because it's a group project. I can probably grade them fairly quickly. I can get them back by next Tuesday's class. So any questions on this project? So on the UTSA library, Merchant Online, and someone was showing me Ibis World. For your paper 3, there's some really good stuff in there. You just put your company in there and see everything they have. It's really, really powerful. If you're using the industry research that Natasha set up, I ask you wholeheartedly to, and you like it, you like what she set up, I really ask you send her an email thanking her for doing that. I really think she's a great librarian. She does a great job. I just sent an email today saying what a great job she does. That somebody else is, oh, thanks for the kind of words, but she's kind of hidden back there doing these Herculean things that really gets much appreciation. So send her a thank you email if you're using her site, because it's really helpful. It helps our class too, because then she'll keep maintaining it. So, all right, we're going to do a quick accounting update so I can unlearn you on the accounting, some of the stuff that you may learn in the accounting class that we don't really think of that way in finance. And then we'll get into paper 4, especially next week. And we may today talk about how to set up paper 4 in the Excel. So we might spend some of the last part of the class doing that. All right, so you're using financial statements. How many financial statements do we have? 3 or 4. We're not going to use the 4th one. So you have the income statement, cash flow statement, balance sheet, and then statement of owner's equity. We're not going to use statement of owner's equity because everything in there we can get somewhere else even better. So what is a financial statement doing? So essentially what you're doing is you're trying to figure out how did balance sheet last year get the balance sheet this year? And what does the balance sheet show you? What the firm owns and who owns it? Liabilities and owner's equity. You're trying to figure out how did that change? And the income statement and cash flow statement is going to show you that. So we have financial statements that are for our point in time, which is the balance sheet, and over a period of time, like income statement and cash flow statement. We're going to follow GAAP, but you will notice, and this you're going to have to think about some, Bloomberg is heavy, heavy, heavy on adjusted GAAP. I've had people say, never use adjusted GAAP. You can't trust it because all that is management taking out the bad stuff to just rotate, because the difference between GAAP and adjusted GAAP is almost always positive and improvement. I've other people say they use nothing but adjusted GAAP. We're going to probably use adjusted GAAP, but you want to be thinking about that. Those who took my investment class, that paper 2, where you had the earnings announcement, where you had reported earnings versus adjusted, those numbers can be radically different. So if they're radically different, you want to at least ask why they're radically different. Was there a strike and they're adding that number back? Was there some major kind of lawsuit or something? But we are going to use GAAP. We're not going to use these other things because we can access to them. If we did this again in the spring with the financial services industry, there are regulatory filings that you can use for those industries. Bloomberg has some of that stuff that you can actually use and get access to it. I'm an insurance guy, and the regulatory filings for insurance companies are incredibly valuable information that I would actually use. All right, so here's something you used to carry in your wallet. So you meet an accountant. They don't respect finance people. You know, there's all this battle between accountants. But if you ever have a problem with an accountant, just show them this. Why does GAAP accounting exist? It's for investment and credit decisions. Accounting exists for finance. Finance does not exist for accounting. The accountants work for finance, all right? I had one finance student say he told his accounting major to go get him some coffee. And I said, no, that's not what I mean. But GAAP accounting, and this is not me saying this, this is GAAP accountant saying this. This is GAAP accounting saying the purpose of GAAP accounting is for investment and decision, and it says something they don't actually believe. What is that? There is what? They could go a little faster. Near the, I don't know where that is. All right, we're gonna spend the entire class reading this. Avoid the area. Y'all know where Park West is? So avoid Park West. If you don't know where it is, you're probably not there. All right. My phone, that's probably what my phone noise made. All right, look at this second one. This one's pretty incredible. Why does GAAP accounting exist? It doesn't exist to tell you what the firm's been doing. GAAP accounting exists for forecasting. All right. And not only forecasting, but the forecast cash flows. GAAP accounting says this. I had this debate with auditors. Auditors hated me at USAA. They finally started avoiding me, which is really nice to have the auditors avoiding you. But they would want me to do something like, how is that going to help us forecast future cash flows? I don't see the purpose of that. And they're like, we're tired of getting sued, just do it. And then what else it do? It produces balance sheets, income statements, and cash flow statements. And the accountants say it needs to be relevant, needs to be reliable, it needs to be comparable. Relevant, it needs to be predictive, which I don't think accounting does that as well as it could. It needs to have feedback value, so when you get a new quarterly statement, you can adjust your forecast because it's giving you that feedback. If it's so complicated and convoluted that you get it and you're like, what'd I do with this? It's not good. And it needs to be timely. I think accountants have gotten really good at this. We do get financial statements. When I started at USA, we were producing financials, I think +7, 7th business day. They cut that down to +3, and they were trying to cut it down to +1. The actuaries couldn't quite go that fast, but we've gotten much more time. You go back to the 40s, 30s, and 40s, you're getting financial statements in the mail months later. Really slow, and on paper where you couldn't do much with it. So timeliness is pretty good. I would probably give accountants a B+ on this part. Reliability, accountants are probably pretty good on this just because of all the lawsuits and the audits. So it needs to be verifiable that you can trust the numbers there. It needs to be neutral. There is some bias there. I was listening to the Motorend's book today. He said he was shocked at management manipulation of earnings. So he does think there was quite a bit going on. So I think a lot of the fact, I mean, the numbers are reliable. I think the reason that there's a lot of noise going on is because accounting is just really complicated. It's hard to put in numbers in a complex business. And then comparability, so I might give them an A- on this, and then I'll probably give them a D on this. Comparability and consistency. Comparability is to other entities, enterprises, and consistency is comparing them over time. We're going to try to do this in paper 4, so you can compare your company to competitors. There are some places that's going to be somewhat of a mess. So if you compare McDonald's, which is mainly franchised, to a firm that's not franchised, maybe a Sonic, I don't know, Sonic franchise, they're going to look radically different. It's going to be really hard to compare them. They're not really that comparable. It used to be a problem with capital leases and operating leases. They somewhat fixed the accounting on that. But there are some places where firms can look really, really different. The one that I was talking about was cost of goods sold. There's a lot of subjectivity on that based on what firms want to show on their gross margin. So you're going to find this is difficult. Consistency can be an issue. If the firm had a major change, they did an acquisition, something like that, they can be tough to compare over time. But we're going to go with what they give us, what Bloomberg brings over, or Capital IQ brings over. We're just going to use what comes in. But it's going to be a mess. It always is a mess. One of the reasons I don't do case studies is because case studies clean up the numbers way too much. I think the Harvard people do nothing but case studies. They go out into the real world and it's like, wait, all these numbers, who's going to fix the numbers for us so we can do our job? The numbers aren't fixed. They're always a mess. So that's why I use real life companies. You got to just see this stuff is messy. It's really quite overwhelming sometimes. All right, so the balance sheet. This is where we're going to make the biggest difference between you and the accounting class. Beverly's seen this, the rest of you haven't. So we'll see if I don't know if I actually convinced her in that class. We'll see. So we have current assets and non-current assets. Current assets are those things that convert. Depends on how you say it, within 1 year. Some say within one operating cycle. There are some firms that have very long operating cycles, but we'll say within 1 year. Accountants look at these as one big group. We don't. We look at these 3 as a group, and this is something different. So cash is outside of the process. Receivables, inventory, prepaids are part of the operations. So we're going to separate those out. Not to put Beverly on the spot. Do you remember what these were called? Do you remember? It's been too long. I'd be really impressed if you do remember. Anybody know this term? Yeah, very good. Net working capital assets. Working capital is an extremely important term that your accountants taught you entirely wrong. The accountants say these are good things. Finance says these are bad things. We don't like these things. All right, so we'll talk about those. But cash is not part of net working capital assets. Actually, it should be working capital assets. Then we come to current liabilities. These 2 belong together. This one, oh, sorry. These 2 belong together. This one does not belong. I might even move it down to the bottom. So what is this? I'm sorry. Working capital liabilities. Accountants say these are bad things. Finance, we love these things. I think they're wonderful. So you have to kind of change your thinking on that. We'll see on that how that is. Non-current assets, we're going to use them. They're actually can be pretty helpful for you. You'll see, especially when we get into papers 5 and 6. Some firms have really heavy property, plant, and equipment. Some have very low. You want to know where your firm fits in. Look at how much your firm's property, plant, equipment is as a percentage of assets. If it's 5 or 10%, that's pretty low. It's 40, 50%, that's pretty high. That's an important distinction for your firm. So NVIDIA has almost none. I can even show you the numbers. Well, it depends. I can't get back to the old one. Sometimes if I'm going through Chrome, it lets me. I'm really, really mad at Yahoo Finance for messing up. They won't even let you go back to the old one. So sorry, I can't even show you that. But if you pull up their financials, you'll notice that NVIDIA has very low property and plant equipment. Intel has massive amounts. They're very different firms. And yet we'll put Intel and NVIDIA in the same analysis. They're very, very different operations, very different firms. So that's going to be important. We're just going to take them as they are, net book value. We're not going to try to value them at market value or anything like that. That can be important to do. I was looking at, what firm was it? I can't remember. The Motorin was talking about it. I think it was Macy's. So Macy's in a lot of trouble right now. They're not doing well. It's like a $7 billion firm, but it owns real estate worth maybe $10 billion. That's when you get in and look at firms that are going out of business or in the decline. Looking at those property plant equipment can be really important because you might be better off just liquidating the firm. And that's what some people are saying about Macy's. Just they have some really, really prime real estate, especially in New York, worth a lot of money, but they're trying to operate this retail operation that's just not working. They're trying to expand their online presence. When's the last time you bought something online from Macy's? It's probably been a while, hasn't it? Maybe 22 years or so. All right. Intangible assets. What are you going to do with that? Look at your firm's balance sheet and see if they have goodwill and how large it is. That tells you a lot. A firm with high goodwill has been doing what? Where does goodwill come from? Acquisitions. Firms with high goodwill have high acquisitions. That's going to be important to look at. Sometimes they have to write that goodwill off because they acquired a firm for more than it's worth today, and has to be written down. There's assets we don't have, like brand value. I showed you on brand value how you can look that up. Research and development may be important for some of your industries. You may want to look and see where that goes. There are some ratios you can do with research and development. We'll talk about with paper 4. That could be really interesting if your firm does a lot of that. So you kind of have to watch that. So what are we going to do with goodwill? We're just going to leave it there, but you at least want to look at it and see how much the firm has. On liabilities, the non-current liabilities, long-term debt, we'll talk quite a bit about. Y'all probably saw the new accounting rules for capital leases, so you could probably teach me. Y'all know the new rules? Sorry, I don't have my shoes on. That's okay. But you remember, there aren't any more operating leases, are there? Aren't they converting them all to capital leases now? Y'all remember? Did y'all go to accounting classes in the last 2 years? That would probably be an important one, but I do think firms don't like capital leases because it puts a lot of debt onto their balance sheet. So they prefer the operating lease. And when I was in accounting, the rules were ridiculous. Really, really complicated. I think the accounting has moved. You can look it up and just see. But do you count a capital lease as part of the debt or not? When I do paper 4, I don't have capital leases in there, but we maybe should add it in there, and it may be something to think about. At least look and see if a firm has massive capital leases, just so we can make sure, do we need to adjust that? A capital lease looks a lot like debt. It could be a 5-year, 10-year contract where you got to pay something every single month. If you don't, you're in default. So look for that. What about defined benefit plans? Some of y'all are probably going to have to address this. Think about it. So someone's doing deer, right? In here or not? No, who's doing capital goods? Yeah, that's y'all, right? Y'all have deer in yours or Caterpillar? So firms like that, heavy labor union, they tend to have massive pension plans. It can be a huge liability on their books. What are you going to do with that? We're going to ignore deferred taxes just because they're a real pain. But you'll see how I address that. Your firm may have some obligations that they're heavily reliant on estimations. Warranty costs. You've got to say, hey, how many warranties we had to honor in the past? What's that going to mean in the future? So that's just a guess. Benefit plans are a massive guess. because you're projecting out 50, 70 years into the future, who's going to die when and what interest rates are going to be and all that. You're somewhat stuck with them, but there are some firms like General Motors that's a big part. That's maybe half of your analysis of the firm. Some people say General Motors is not an automotive manufacturer. General Motors is an employee benefit plan that happens to sell a few cars on the side because that's a massive part of their business. And then what does GAAP say about other obligations? If there's less than a 50% chance of happening, or if it's difficult to quantify, they don't put it on the balance sheet, but they still put it in the footnotes. So it may be something to look into the footnotes to see if they have something like that, some pending lawsuit. These off-balance sheet obligations, not a very popular term after Enron, but firms do have stuff going on that they don't tell you about. They try to hide. I'm not asking you to do too much of that, but always be thinking about that. Owner's equity, we're not going to really use that statement. The flow statements, income statement, and statement of cash flow. Look at how your firm puts things together, revenues, expenses, gains, and losses. We usually think about revenues and expenses as being above the line and gains and losses below the line. So when you get adjusted GAAP, they're usually taking those gains and losses out because they're not part of the normal business. So think about that. They have some unusual gain that went up. One of the charts we're going to look at is comparing EBIT, our net income, to cash from operations. A lot of times those two can get distorted because of some massive realized gain that went on that will distort those two numbers. So this brings up the ideal quality earnings. I'm going to actually have you in paper 4 discuss quality of earnings. I got a chart that I like to use. So does management try to downplay some horrible thing to happen and say, oh, that only happens once, don't even look at that? Then you look back and say, well, that happens like every 3 years. That looks like that's something we should count as normal. Income smoothing is very popular. Firms that have good years will tend to load up on extra expenses so that the next year will look better. When they have bad years, they'll try to push things out to a future year. That does happen. I was on a board of a credit union, and we had some accounting choice we could make. We could take the charge this year or next year. And the first question the board asked was, "Oh, what kind of year are we having this year?" And I was like, "No, you can't ask that question. The question is, what year should it go in? Not what year are we going to smooth it over it into?" Firms do that. Big bath. I was just talking to someone about the big bath theory. You just had a horrible year. You're crashing. You have a new CEO. Let's load this year up with everything we possibly can, so the CEO can say next year is going to be wonderful and great. Firms definitely do that. Where are you worried? And your biggest concern are the accruals, receivables, inventories, accounts payables, those things that can be manipulated and can impact earnings. How do you find these? You find them because net income and cash from operations get distorted. And that's how we're going to look for them. You'd assume CFO and net income should move somewhat together. Sometimes you'll have big bumps, but they'll be corrected the next year because things happen. But if you start seeing CFO and net income diverging over time, there's a good chance, man, cooking the books. A book I highly recommend, and it's probably pretty cheap. This guy, Howard, he wrote it. I thought it was an excellent book. I don't know if he's still alive. He had a firm that he sold to someone. I don't remember who he sold it to. How do you look inside? There used to be a way to look inside, but I don't see it. Yeah, it's not in there. All right, so what he's trying to do is help you just identify when management is cooking the books. And it's really well organized. If you look through, that's why I wish I could look into it. There's a newer edition, but so get the newer edition. Read sample, maybe that would work. All right, there we go, that might work. You might think this is a book for accountants, but I actually think this is a book for finance majors. So he does some history of some of the most famous cases. And then he says, okay, Earnings manipulation, revenue, recording revenue too early. How do you find that? What would that look like? Well, it's probably going to look at like, a bump in revenue, but what his argument is, if management manipulates the income statement, which is what they try to do, they usually have to distort the cash flow statement or the balance sheet. And so what you're going to do is you're going to find these by comparing those statements. Recording bogus revenue, he gives some really wild stories on that. Boosting income using one-time activities and not putting them below the line. Shifting current expenses to a later pay period, that's the income smoothing. Employing other techniques to hide expenses, shifting current income to a later period. So he goes through each one of them on this cash flow statement. Metrics. So he goes through each of them. He gives examples, but the best thing he does is he tells you how you find them. What is the distortion between the statements so that you can see a management is doing something like that? So how do you recommend it? It's only 300 pages and it only costs what? What's the price? There's no price. It's free, I guess. I don't see it.
Is that 21 on the right?
Do you see it?
No.
Oh, 21 bucks. That's Kindle. Hardcover, 13 bucks. It's a lot cheaper in your textbooks. And this is valuable in any textbook. It's a really good book. Very well written. I don't know how to say his name, but Howard, good writer. He even got 4.6 stars. I don't know who would have given him 1 star. Gave him 1 star just because he doesn't like management. I mean, my word, great to author. Anyway, I highly recommend that book. It's a good book. It's one you could read. You could read, while you're exercising, read Audible, but it's probably one you want in paperback because it's one you're going to go back and reference. So it probably makes more sense to actually buy the paperback of it. Statement of owner's equity, we're not going to use that one. I think we already talked about. All right, statement of owner's cash flows. Do you all tell me the 3 pieces? Cash from operations, investing, finance. So build a new building. What is that? Investing in USU new stock. Financing. Okay. You pay down debt. Pay down debt. That's financing. You acquire another firm. Investing. You pay interest on debt. Operating. That's the one that the accountants get wrong. All right. Where should interest expense be? Should be a financing cash flow. Why is it in operations? We don't know. When you take the CFA exam, that's the one thing they're going to say. Take interest expense and move it from CFO, add it back to CFO, and put it down in financing. Why they don't fix that? Because whom do the accountants work for? They work for finance. What is finance saying? Interest expense should be in. So we don't have as much power as we should. Yeah, so cash from operations. It's essentially net income on a cash basis, but there are some things that hit cash from operations that are pretty material. And you want to understand these. So when you look at it, let's do a clear one. You sell an asset for a large gain. Sales price, let's say, is 1 billion. Realized gain, say, is 250. All right. What goes through your investments? $1 billion. You have a $1 billion inflow in your investments. Okay. What goes through your net income? 250. So how do you need to adjust net income to get the cash from operations? Your net income has 250 million in it as a realized gain, but where's that realized gain in your cash flow statement? It's part of that $1 billion, isn't it? So you can't just leave it at net income when you take net income and just for cash flow, because your net income is $250 million too high because you got 250 is in the $1 billion. So what do you have to do with the realized gain? In CFO, you have to subtract it out. Why are you subtracting it out? Because it's in that $1 billion. So your firm might have a massive $250 million adjustment to cash from operations. That's negative. And you go, what happened there? That's terrible. No, it's not terrible. They sold something for a big gain. It's just that 250 is already in the investment side. What if they have a big loss? What are you gonna do with the cash from operations there? You're gonna add it back. Right, so that you can see CFO, you see some of the CFO, wow, they're adding back 250, that must be really good. They have more cash than their net income does. No, they don't have more cash than net income, it's the cash is in the other place, it's in the investing. Right, your investing only had $1 billion, I mean, had $1 billion. But you sold something worth on your books at 1.25 billion. So your accounting had to take that 2.25 out. So $1 billion's all you got. You don't want that in your cash flow. What if you do a $350 million pension funding? Where's that going to go? Not investing. It is not net income. It doesn't impact net income at all. So what you have to do, you have to subtract that out of CFO. That's $250 million. That was operation, but it didn't go through net income at all because of the way pension accounting works. So how do you handle this? I'll show you. In fact, I'm hoping some of your companies have these problems, and I'll show you how to research them. But the way I do it is I see that big number there, and I can't tell from Bloomberg and Capital IQ because it's too summarized. I go to the end report, and I'm just looking at the year versus year cash flow statement. I'm looking for that one big jump, try to explain why there's a big jump in CFO that wasn't in net income. So there's a bunch of them, and they can get really tricky. Sometimes deferred tax can cause that. We saw that with deferred tax when the Trump had his tax bill. Firms had to radically change their deferred taxes, and you saw that big adjustment going through CFO. So we're going to have on quality of earnings, we're going to compare cash from operations to net income. And we're concerned when there's a big divergence, but just realize some of those big divergences are very perfectly fine. But you might want to go and research them just to make sure. It's probably not a problem if the divergent was like 2017, something happened, but it was okay in 18, 19, and 20. Your biggest issue is going to be if it happened this last year, or some big adjustment this last year. That you're probably wanting to go and research and see why did net income and cash from operations diverge so dramatically. The biggest adjustment that you're expecting are depreciation. You add that back, right? Add that back to cash from operations. And in change in working capital, hopefully y'all remember this. Accounts receivable increases. What do you do the CFO with that? Take it out. You subtract it. So if accounts receivable increases, inventories increase, you subtract that from CFO. Accounts payable increases, you add that back to CFO, all right? So working capital normally is a subtract for a growing company, is a subtract from CFO. Those are generally the two biggest issues. So those are the two I highlight. I give you depreciation, I give you working capital. And then on that's when you see those realized gains, those pension fundings, those type of things. They're big bars that happen every once in a while. But if management is cooking the books, this is the one you're going to notice is getting out of whack over time. Something bizarre is happening. Most firms, it's kind of volatile, sometimes positive, sometimes negative. But if you see a firm where it's a subtract from CFO and it's getting larger every year, they're probably cooking the books and there's something going on there. Financing activities, the biggest one there is CapEx. I'm sorry, investing. I'm sorry, I jumped in. The financing activities, that's, stock issuance. We're going to look at those as well. That's pretty important. We're going to have this concept of free cash flow. And free cash flow we're going to look at free cash flow from the standpoint of what is management doing with the free cash flow. So we'll do some analysis there. Interest expense should be there, but it's not. And then investing activities, the big thing there is CapEx. And a big question you want to ask on CapEx is how does the management spend their CapEx? We talked about that earlier. If they have an economic moat, you want them spending CapEx to protect that economic moat. Very, very important that they keep that in place as long as they can. We can ignore that. So which is better, cash from operations or GAAP net income? The answer is yes. It depends. They both have their role. Cash from operations is the easiest to manipulate because you could just delay a purchase from December 28th to January 3rd, and you get it in the next year. So accrual accounting tries to get around that. But accrual accounting lets you manipulate because there's a lot of assumptions, a lot of estimates in accrual accounting that cash accounting doesn't have. So my argument is use them both, look at them both. finance tends to be more focused on the income statement than the cash flow statement. What I don't understand, and y'all make me explain this to me, which is better between EBITDA and CFO? Well, first of all, what's the major difference in EBITDA and CFO? We talked about it up above. So what do we add back? We added back depreciation for CFO. What are you adding back here? Depreciation. So those two are the same. So what's the big difference between EBITDA and cash from operations? Net working capital requirement. I think net working capital requirement is important. So I like CFO. I like having CFO lower because receivables grew, inventories grew. EBITDA ignores that. So I don't know why we like EBITDA versus CFO. CFO should be the number we're interested in. It seems like a much more useful, powerful number. The motor end says we like EBITDA because we like saying EBITDA, like it's some fancy accounting term. CFO just doesn't sound as impressive. If that's the reason, that's not a good reason. So maybe we need a fancier term for CFO dollar or something. But I prefer CFO, but I know most classes overuse EBITDA quite a bit. So we had to address this issue of free cash flow. We'll probably talk about this some on Tuesday. I want to show you the Excel spreadsheet just real quickly. When you get the valuation, I'm going to encourage you to use free cash flow instead of dividends. And I'll show you a quick way you can adjust it. If you took, how many of y'all had Catapacum? Y'all are free cash flow experts, right? So he's the best. He teaches that really, really well. I'm not going to be quite as precise as he is because just for sake of time, but if you want to be more precise, you can. Bloomberg will give you a free cash flow number as well. It's going to match very closely to the way I do it. It probably won't match the way Catapacum does it. So I'm not going to be real picky on how you calculate free cash flow. I'll give you my definition. You can use it, but we do want to do that for free cash flow. Let me show you the model though, just real quickly so you see where we're going. Beverly's already seen this, but is one of your companies up here? Anyone doing Costco or Deere or Netflix? You're doing Netflix. So I'll do Netflix. So I'll show you this model. So what you're going to do, so you're going to put your company in there. I give you the Russell 3000, your company in there, and you're going to have competitors. So you might start thinking about this spreadsheet as who are your competitors. I have a video that shows you somewhat how to get through that, but you want to have a more expansive list of competitors here than you did in your paper too. You really want to add a lot of companies. So for me, Walmart, people doing Walmart, they're looking at Walmart, Kroger's, Costco. For this paper 4, you want to include Home Depot, Lowe's, Kohl's, a bunch of others. So you want to do that. Once you do that, you'll get these all lined up. You put your company in here. What this spreadsheet does is we're doing a lot of medians, and I cannot get Excel to calculate medians correctly. I'm trying to do a blank cell, and it keeps interpreting my blank cells as a cell, so it's messing up the medians. So what I did, I had AI write the macro because I'm getting lazy. Asked my AI to get rid of all those blank cells so that the median's correct. If you don't want to run that yourself, I'll run it for you. But once you do that, it gets your company with plenty of data that we're going to use to value the firm. Assess the firm. So you can get all this data in here. Some of the stuff you won't use because Netflix doesn't have square feet, so we'll just hide those rows. And then it has a bunch of charts. And the way I do the charts, I really like this approach, is I have the industry median, I have the 10% and the 90%. So we can say Netflix is incredibly good at revenue per employee because they're up in that top 10%. Asset turnover, they're not so strong, but there are strong gross margins. They're kind of below average. I don't even know what a gross margin for Netflix is. That's some Hiram's going to figure out. I don't know what is their cost of goods sold. It might include some of those production costs, which would make, and then, so you got the charts. You notice some charts just look ridiculous, but watch how I fix this. Problem solved. So you can just, a lot of times the 10% chart because of COVID, it just messes everything up. You just take it out. Or if it's only 1 point that's taking it out, you can just take it. And I'll show you how to do that. So our goal this next week, once we get paper 2 in, you're working on paper 3 by yourself, right? It's not a team paper. Is while you're working on paper 3, we got to get this file populated. So this next week is going to be important that we bring this data in, get paper 2 out of the way, and start thinking about this while you're working on your paper 3, so that we can start getting this data in. I will in class be bringing up your companies. I'm using Walmart as my example, but I don't want to just use Walmart. I want to bring your companies because you're going to see some stuff that's just wow. And so I'm hoping we'll have a few places where you see some, why in the world did the chart do that? We can go to the annual report, find out what happened there, and do a little bit of work on research. How do we research something and find stuff out? If you are intended to be in finance, you'll know it, because when you see a chart do that and you don't know why, you can't go to sleep until you figure it out. Not because of the class, but because you're just so curious. Like, wait, why did that happen? That didn't make sense to me. The revenue shouldn't have done that. That's when you know you're a finance person. You just can't wait to figure it out. So where I'm using Capital IQ to bring the data in, what I did here is I brought it into Capital IQ and then I converted it to values so I could use it, because Capital IQ, if you load it, it takes forever to repopulate. But there are some data points that you might want that aren't in here. So how many of y'all have Capital IQ working at home? A few of y'all. If you have a Mac, it doesn't work. But the nice thing is the IT people here, they got every machine in FSC with Capital IQ working. You don't even need your own account. You get in, it works. It's wonderful. So if there's other accounts that you want, go up to the FSC, bring them in. Capital IQ is real easy. You just click on find field, you find the field, bring it in, copy the formulas down. I already have the formulas set up. So like research and development may really be really important to you, and I didn't bring it in. You may want to go pull that data in. I gave you a few ratios that don't apply, like inventory turn, that, you know, just in case you need it, but I didn't do all those just in case. So we'll try to find those extra ratios. I may give you some ideas of what you do as we're in there. If you can get Capital IQ in class, that would be even better, because then if you need something, you could pull it right here in class. But y'all see where we're going. The key is to get your firm set up. You just put a 2 by your firm. So what I recommend that you would do, I'll just show you this real quickly, is in this file, columns A through I would copy that and paste it in values in another spreadsheet so that you can manipulate this. And then you're probably going to sort it by industry or something. You have to look through and just see what options you have and sort it through. And then when you copy it back, be real careful. Y'all should need to write this down. When you copy it back, only go through column D. All right. But the reason I recommend that is Capital IQ. If you have Capital IQ going, every time you change anything, it starts loading stuff again, and it takes forever. So it gets really frustrating. But you'll notice in here, and just make sure everybody's aware, once you get past column D, it's a bunch of V lookup formulas. So you only need to bring in these first 3 columns where your 2 and your 1s are. You copy and paste that in, and V lookup brings everything else in for you, and Capital IQ works. Everything else works. All right. I doubt you're going to work on this, so we'll do a little bit more of this on Tuesday. I think I have a Bloomberg that shows you how to do this. I mean, YouTube that shows you how. But just be aware, this is coming up. So next week, this would be your focus. You really want to get this done before, say, the end of next week, maybe even before that. All right, questions on any of that? So I'm doing all the work for you here. I got the spreadsheet built for you. You just got to do the analysis, which is the fun part anyway. So, all right, we'll stop it there.